Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 9th of March. Let's dive into the week's top market news. Geopolitical instability and inflationary pressures. A weekly analysis of European markets. After several consecutive weeks of steady gains, the European financial landscape has undergone a sharp reversal. The Pan-European Stocks Europe 600 index recorded a significant contraction of 5.55% in local currency terms over the week, marking one of its steepest recent declines. This deterioration in risk appetite is primarily attributed to escalating tensions in the Middle East. Military strikes involving the United States, Israel, and Iran have fueled fears of a wider conflict, prompting investors to adopt a stance of extreme caution. The reaction was evident across all major continental indices. Germany's DAX lost 6.70%. Italy's FTSE/MIB retreated 6.48%, and France's CAC 40 saw a decline of 6.84%, while across the Channel, the UK's FTSE 100 index fell by 5.74%. The military action in the region triggered an immediate surge in oil and gas prices, raising serious concerns about the effects that sustained high energy costs could have on economic growth and price dynamics. Data released by Eurostat indicates that inflationary pressure was present even before the intensification of the Iranian conflict. In February, annual inflation in the Eurozone hit 1.9%, exceeding both the 1.7% registered in January and market consensus expectations. Consequently, trader expectations for monetary policy have shifted dramatically, with the probability of the European Central Bank, ECB, implementing further rate hikes now exceeding 50%, further complicating the outlook for corporate borrowing and the cost of capital. Despite the macroeconomic uncertainty, the Eurozone labor market continues to show signs of surprising resilience. The seasonally adjusted unemployment rate fell to an all-time low of 6.1% in January, a figure slightly better than both the previous month and analyst estimates. Positive news also arrived from the youth inflation front, which declined from 15% to 14.8%. This employment stability represents a crucial factor that the ECB will need to monitor closely, as it could fuel further wage pressures and make underlying inflation more persistent. Italy fits into this context with contrasting but overall encouraging macroeconomic data. Italian gross domestic product, GDP, recorded an increase of 0.3% in the final months of 2025 on a quarterly basis. Growth was mainly driven by gross fixed investment and the housing sector, while net foreign demand provided a negative contribution, penalized by an increase in imports against weaker exports. Particularly relevant is the national unemployment figure, which dropped to 5.1% in January, a level significantly lower than both the 5.5% registered in December 2025 and the 5.6% expected by economists, demonstrating a phase of particular vigor in the domestic labor market. In the United Kingdom, investors are navigating a period of uncertainty as they weigh the inflationary risks stemming from the conflict. Sterling fell to its lowest level since early December, reflecting the Office for Budget Responsibility's warnings regarding the very significant impacts that geopolitical tensions could have on the UK economy. Sectoral data remains mixed. The S&P Global UK Construction PMI fell in February due to a reduction in new orders, suggesting a slowdown in construction and infrastructure. Conversely, the residential real estate market provided a positive surprise, with the Halifax House Price Index reporting a 1.3% year-over-year increase in house prices, beating market expectations and indicating a steady demand for housing despite the high interest rate environment. Now our insight into alternative markets. The strategic evolution of the secondary market, navigating value and uncertainty in 2026. The private equity secondary market has long ceased to be a niche segment, evolving instead into the true financial heartbeat of the industry, capable of providing essential flexibility and oxygen to the entire system. If the primary market represents the inception of an investment, the secondary market constitutes its stage of dynamic maturity, allowing for the exchange of existing commitments between investors. This financial infrastructure operates through several key channels, ranging from common transactions led by limited partners seeking liquidity or portfolio rebalancing to more sophisticated operations orchestrated by general partners. In the latter, managers utilize so-called continuation vehicles to retain high-quality assets beyond a fund's natural expiration, offering investors the crucial choice between cashing out their capital or reinvesting in the company's future. Furthermore, direct secondary transactions allow for the immediate exchange of stakes in individual companies, bypassing the collective fund structure entirely. The appeal of this market lies in its ability to solve structural issues inherent in investing in illiquid assets. Those who purchase on the secondary market not only gain rapid access to liquidity, but also successfully mitigate blind pool risk, as they are investing in corporate entities that are already known, analyzable, and possess a consolidated performance history. Moreover, by entering at an advanced stage of the fund's life cycle, investors can accelerate their own returns, significantly softening the effects of the J-curve that typically characterizes the early years of private equity. However, looking at the landscape of the first half of 2026, we are faced with an unprecedented dichotomy. On one hand, we are seeing record demand for liquidity. On the other, we sense an extreme caution generated by a series of exogenous shocks that are reshaping the rules of the game. The most disruptive factor is undoubtedly the uncertainty surrounding artificial intelligence. The rapid pace of technological evolution has made due diligence on software portfolios extremely complex, causing several transactions initially planned for the beginning of the year to slip. This is compounded by a tense geopolitical framework, where conflicts in the Middle East and instability in Latin America have triggered sharp volatility in energy prices, directly impacting capital flows from major sovereign wealth funds. This situation has created a significant gap between sellers' price expectations and buyers' offers. In the absence of immediate catalysts capable of driving valuations, the market is responding with creative contractual structures, such as deferred payments or those linked to future performance, to bridge the valuation gap. Yet, precisely within this climate of uncertainty, a fundamental thesis emerges for those who can look beneath the surface. The complexity of 2026 is not an insurmountable obstacle, but a valuable filter for disciplined investors. We currently find ourselves in what can be defined as a buyer's market. Investment firms with ready capital have a rare opportunity to move in a highly selective manner, acquiring excellent assets at significantly more competitive prices compared to the recent past. The pressure many investors face to obtain immediate liquidity allows new buyers to command stronger negotiating terms and build resilient portfolios based on a deep understanding of technological and macroeconomic risks. In conclusion, while prudence remains a mandatory requirement, the 2026 secondary market is emerging as one of the most interesting windows of opportunity in the last decade. The ability to distinguish intrinsic value from the background noise of volatility will, from now on, be the true dividing line between those who are subject to the market and those who, with foresight and selectivity, will drive its future returns.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, Don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.